Many businesses have faced challenges since the economic downturn after 2008. Deals that initially seemed financially sound can appear less stable several years later, leading to distressed debt situations. This typically happens when a company can't cover its debt using its cash flow now or in the future, or when the company breaches the terms set by lenders. If all the strategies we've covered are applied well, it's less likely a company will end up in this position. Looking at the summary of distressed debt shown here, you can see the company's cash position fluctuated, with a low point of negative £24.9 million at the end of 2021 and a high point of £15.7 million back in 2012. These figures illustrate how the financial health of a company can change significantly over time, which might necessitate restructuring or refinancing to regain stability. The debt service cover ratios are currently below the minimum targets set by the lenders, indicating a challenging financial position. There isn't enough cash flow to service or repay the debt, and based on cash flow projections, the cash balance would turn negative by the end of December 2015. This situation points to a clear need for a restructuring plan. When a company faces distressed debt in a leveraged buyout, there are generally three options: improve business performance, reschedule debts, or make a strategic sale. Improving business performance means focusing on boosting earnings before interest, tax, depreciation, and amortization (EBITDA), by increasing sales, cutting costs, or lowering overheads through cost reduction programs. The company plans to implement an operational restructuring that includes an enhanced sales and marketing strategy aimed at growing sales and improving the overall financial health. This approach is intended to help move the company back toward meeting lender requirements and stabilizing its debt position. The company's cash position has improved significantly, with the minimum cash balance recorded at £15.3 million on December 31, 2011, and the maximum reaching £115.9 million by December 31, 2021. When we look at the lender's credit ratios, all key metrics fall within acceptable targets. The debt-to-equity ratio peaked at 78.6%, just under the maximum target of 80%, while the average stayed solid at 63.2%. Debt-to-EBITDA reached a maximum of 163.2% in December 2012 but averaged 85.9%, showing ongoing management of debt levels. Debt-to-net assets remained low, with a maximum of 20.2% against a high target of 90%, and an average of 13.2%. Importantly, the debt service cover ratio never dropped below 2.5, well above the minimum threshold of 1.1, with an average of 3.4, indicating strong capacity to service debt. In addition to these financial improvements, the company has plans to outsource products from suppliers in the Far East, which should help reduce costs. A cost reduction program has also identified several savings opportunities. Together, these operational improvements support the positive cash flow forecasted and maintain the company's strong financial health as reflected in these credit ratios. The company has identified an operational improvement by changing its product sourcing strategy, but this alone wasn't enough to meet the debt service cover ratio target, which remains just below the minimum at 0.9 instead of 1.1. To address this, the company negotiated with the bank to extend the repayment period on its senior debt from 7 to 10 years. This extension didn't come with any additional fees, though the company will pay more interest over time because of the longer term. This adjustment has successfully improved the company's cash position and ensured that all the lenders' credit ratios are now within acceptable limits. For example, the minimum cash balance was £10.8 million at the end of 2020, while the highest was £24.2 million back in 2012. Key credit ratios like debt-to-equity and debt-to-net assets also remain within target levels, confirming the restructuring has strengthened the company's financial stability. One approach to managing debt service obligations is through strategic disposals, where certain companies or divisions are sold to generate cash. This cash can then be used to prepay debt, which helps reduce the burden of servicing that debt and move the business toward a more financially stable position. Often, these disposals involve parts of the business that may have struggled recently but still hold strong potential for the future. Another key strategy is capital reconstruction, which is useful when a business shouldn't be liquidated but needs to be rescued. This process involves placing the failing company into voluntary liquidation and transferring its assets to a new company that has the same name and shareholders but a healthier financial structure. For this to work, it's crucial to convince creditors that recovery through reconstruction offers a better outcome than liquidation. Modifying claims may be necessary to maintain the company's status as a going concern. The example referenced here highlights a company with good long-term prospects but difficult recent performance, illustrating the challenges and benefits of such a reconstruction. This strategy can help preserve value and keep the business operational rather than ending its operations completely. The company has several financial obligations that need addressing, including professional fees for winding up, outstanding employee salaries, corporation tax, VAT, secured and unsecured creditors, and ordinary shareholders. To restructure the company, a scheme involves issuing new debt worth £7 million and providing senior debt holders with shares valued at £5 million. The plan aims to repay unsecured creditors and use the remaining funds to boost working capital. According to Exhibit 3.17, these assumptions form the basis of the company's position. Looking at Exhibit 3.18, the balance sheet of this insolvent company as of December 31, 2014, shows £8 million in total debt outstanding and a £0.3 million overdraft. The company has no collectible trade debtors, which limits cash conversion options. Fixed assets are valued at £2.8 million net, while current assets total £2.8 million, including cash and stock, but with negative accounts receivable indicating the overdraft. This financial situation underscores the need for a restructuring approach to manage debt and improve liquidity. The balance sheet shows that the company holds fixed assets valued at £2.8 million and current assets amounting to £19.6 million, but this is based on historic cost. In reality, when the company was liquidated, only £5 million was recovered from selling these assets. The key question then is how this £5 million is distributed among the creditors and other parties. We follow a specific order of priority for payments. Professional fees for winding up the company, which cost £33,000, are paid first. Next come the outstanding employee salaries, which total £900,000. These initial payments are crucial as they take precedence before any remaining funds can go towards settling other liabilities such as accounts payable, VAT, tax, and long-term debt. This summary highlights how, despite the company's reported assets, the actual cash available during liquidation is limited and must be allocated carefully according to legal priorities. The liquidation summary details how the £5 million raised from selling current and fixed assets has been allocated. Professional fees, salaries, and taxes are all fully paid, and most of the senior debt has been settled. However, the majority of claims remain unpaid, including part of the senior lender's debt, all trade creditors or accounts payable, and the entire shareholders' loan and ordinary shareholders' capital. The analysis reconciles total claims properly by allocating payments in the correct order. The unpaid claims of £20.933 million include various outstanding obligations. To address this, the company plans to raise £7 million of new debt from the market, convert £5 million of senior debt into £1 ordinary shares, and settle the accounts payable of £1.5 million. These steps are designed to restructure the company's balance sheet, as we will see in the next exhibit. The company's cash position has improved to £5.2 million, showing a healthier liquidity compared to before. At the same time, total debt has increased slightly from £8 million to £10 million, mainly due to the introduction of new debt alongside a reduction in senior debt. Equity has also grown from £15 million to £20 million, reflecting the capital injection and restructuring efforts. This means that all parties, both creditors and shareholders, are in a better position after the reconstruction. While the original shareholders' control is reduced due to the new shareholders, they stand to benefit from future dividends, which wouldn't have been possible if the company went into liquidation. The key issue now is to determine if the company can sustain itself long-term. To find out, we need to revisit our financial models and analysis to assess the business's viability moving forward. To evaluate whether the company can support the revised capital structure, we rely on projections that reflect its growth prospects and demonstrate financial viability for all stakeholders. Exhibit 3.21 captures this through the inclusion of the reconstructed balance sheet aligned with the reconstruction plan, along with standard assumptions applied to a 10-year forecast period. This exhibit incorporates the adjusted debt and equity terms, and the profit and loss, cash flow, and balance sheet projections that justify the new debt interest and repayments. Importantly, the lender's credit ratios are recalculated to include this new debt. The results indicate the reconstructed company is viable under these base case assumptions, with new shareholders earning a nominal internal rate of return of 42% and a real rate of 38%. The company maintains a positive cash position, peaking at £112.1 million by the end of 2020. Furthermore, Exhibit 3.22 confirms that all lender credit metrics meet or exceed required targets, with the debt-to-equity ratio peaking at 33.3% against an 80% threshold, and averaging 22.1%. Overall, these projections support the conclusion that the capital structure reconstruction is financially sustainable. Looking at these key financial ratios, we can see that the company's free cash flow to debt is well above the target maximum, indicating strong cash generation relative to its debt. The debt-to-EBITDA ratio remains comfortably below the target ceiling, showing the company can manage its earnings against its debt load. Debt to net assets is also within acceptable limits, which suggests the company's leverage is reasonable compared to its equity. The interest cover ratio is significantly higher than the minimum required, meaning it can easily cover interest payments from its earnings. Altogether, these figures indicate the company is in a solid position financially. In summary, when a company faces distress, it has several options. It can work on improving operational performance, reschedule or restructure its debts, make strategic disposals of assets, or rebuild its capital structure. Only in the most severe cases would liquidation be considered. This approach helps protect the company's value and supports shareholders in navigating financial difficulties.